The future of crypto looks very similar to that of the dot-com bubble. Many of the big names went out of business and many of the tokens collapsed. But many institutional crypto companies have popped up. And in the middle, there has been a parade of hero to zero stories. The question is, can crypto sustain the frenzied growth that has taken place? Security is a concern for the future of crypto and blockchain. With more organizations facing data breaches, it is important to ensure data is protected. Moreover, hackers are targeting IoT devices because they have sketchy security features. Blockchain technology offers a solution for these security problems by decentralizing the administration of a block of data and preventing it from being accessed by a third party. Blockchain devices can detect suspicious commands, making them more secure. Companies from different sectors are quickly embracing blockchain security. For instance, companies from the financial sector are using blockchain to protect their most important data. Banks are targeted by an average of 85 cyber attacks every year, and 1/3 of them result in the compromise of confidential information. Such attacks can cost organizations millions of dollars, so blockchain is seen as an ideal solution. Healthcare providers can also leverage blockchain to securely store patient records. Blockchain provides an additional layer of security by allowing medical records to be written directly into the blockchain. Furthermore, it provides an assurance of integrity. With the help of a private key, these medical records can be encrypted. This way, the privacy of patient records can be preserved. Aside from data security, blockchain technology also allows for decentralization, which means that there is no single point of failure. This makes it impossible for hackers to infiltrate a network. Thus, it may be one of the most effective mitigation strategies for cyber threats. However, the technology is still in its early days and will face some challenges. Despite its nascent stage, the technology is becoming increasingly useful. Many industries are already implementing blockchain technology to process payments and manage the flow of goods and services. Additionally, blockchains can be used to store medical records and other personal information. This ensures the integrity and fidelity of data, and creates trust without a third party. As cryptocurrency becomes more widely accepted, the institutional interest in this new asset class grows. According to a recent study by 1/3 of hedge funds and 13% of private equity firms plan to invest in crypto assets within 1 to 2 years. But there is still a lot of legal uncertainty surrounding the industry, which is holding back big institutional money. Institutional investors have been hesitant to enter the crypto space in the past, mainly because of concerns over compliance with KYC and AML regulations. Furthermore, crypto is a pseudonymous asset and institutions need to know who is on the other side of the trade. Nonetheless, the landscape of institutional involvement is rapidly changing and regulatory issues are being worked out. The increased institutional interest in crypto is important for the future of the industry. It will lead to more integration between the crypto world and mainstream financial services. But this integration will need time and patience. It's vital that institutional investors have a solid understanding of the technical aspects of cryptocurrency. Institutional involvement in crypto will also help the industry grow faster. While this is only a small percentage of the total investments made in crypto, it shows that institutions are beginning to understand the concept. For example, BNY Mellon has launched several tokenization projects and has a separate cryptocurrency unit. In addition, prominent hedge fund manager Carl Icahn has expressed interest in the crypto space and has hinted that he may allocate as much as $1 billion to this new asset class. Other prominent institutions that are getting involved in the space include HSBC, JP Morgan, and UBS. These organizations are actively developing their own digital token and blockchain platforms. Stablecoins were created as a solution to the high price volatility of unbacked crypto assets. As a result, their prices are relatively stable, which predestines them for a variety of functions. However, as the events of early May showed, stablecoins are not without their flaws. The fact that stablecoins are backed by reserve assets gives them a direct link to the traditional financial system, which warrants policymakers' attention. Although cryptocurrencies are gaining popularity, regulatory and legal issues surround their use. According to the Milken Institute Center for Financial Markets, 1 out of 5 households in the United States have interacted with crypto. As a result, many lawmakers have introduced legislation to regulate the industry. Representative Gottheimer and Senators Loomis have introduced bills that will provide a framework for stablecoin regulation. Moreover, the U.S. Treasury is currently working on a bipartisan legislation on crypto assets. Stablecoins have many benefits, including lower costs and safer payments. They may also help connect the unbanked to the financial system. In addition, they could make the process of accepting payments cheaper and easier. Stablecoins are also expected to connect many unbanked areas to the financial system. However, there are also dangers associated with them. While they offer low-cost, safe, and competitive payment options, they may also cause instability and disrupt price discovery and trading. Regulators are also closely monitoring stablecoins. They are not entirely clear on how to regulate them, and they may end up treating them as bank deposits or securities. Meanwhile, the White House is set to release a government-wide strategy on digital assets, asking federal agencies to assess their risks. The SEC has long struggled to be taken seriously, and it has earned a reputation for ineffectiveness. For example, it has a much smaller budget than the CFTC, and is generally only concerned with keeping the average Joe from being ripped off. The SEC can fine people, but that's about it. The DOJ, on the other hand, prosecutes criminals and can prosecute fraud. The SEC has repeatedly expressed its skepticism about cryptocurrency, saying that the volatility, lack of regulations, and investor protections are all issues that need to be addressed. While the current chair of the commission has said he does not plan to outlaw the industry, he has consistently rejected applications to license ETFs that invest in cryptocurrencies. Despite Gensler's stance, he is urging crypto companies to meet with him to discuss regulatory issues. He also believes the SEC should be a cop on the beat and not share jurisdiction with the CFTC. Meanwhile, 2 crypto companies have filed for ETF approval with the SEC in October 2021, the ProShares Bitcoin Strategy and the Valkyrie Bitcoin Strategy ETFs. However, these ETFs will only invest in Bitcoin and Ethereum, because they are the only 2 cryptocurrencies with active futures markets. In addition, Bitcoin and Ethereum can be used as legal tender and a store of value. The SEC's recent announcement of its future of crypto regulation emphasized that the regulatory bodies must ensure a level of safety, regulation, and cyber resilience before embracing crypto. The SEC has not yet decided whether or not to merge with the CFTC, but it has recommended that they merge with one another to help consumers and ensure the safety of the crypto market.